Yo, what up, YouTube? How's it going? How's that lighting going? We're gonna get started here. We're gonna bring you the macro, the technicals, We got earnings today. We got Microsoft. I think Microsoft, Google. We'll see what happens. The market is trying to price that in. I am looking at Chainlink here. This is this thing's up like 100%, 80%, something like that. Bitcoin's breaking out. Crypto's breaking out. We have a lot of macro. Okay, I know the economy. They say the economy is collapsing. Everything's gonna fall apart. But let me bring you some charts that show that is not actually what's happening. If you disagree, let me know. Send me some charts. Let me know what you think. But let's get this content going. Okay, first, let's dive into the technicals here, right? We're gonna start with the technicals. We're gonna go to the macro economics. We are gonna hit up on earnings, the fundamentals. Switch to this chart. Actually, here we go. Crypto, man, I've been watching crypto. It is starting to move now. The dollar, we're going to talk about the dollar too. I know a lot of you guys trade Forex. The dollar, it's bullish. It was breaking down a little bit, but it's looking kind of bullish. Actually, let's turn this into a falling flag pattern. So the dollar looks kind of bullish here. And I think this is going to depend on how rates come out, right? So you can see that there. Alrighty, so here's what we got. Let's go to the S. We always start with the S&P 500. S&P 500 at 422. Sorry, 424. No, we're at 424. A lot of volume coming in. And I think what you want to focus on here, the S&P is holding the 200 moving average. You see that? Do we need this chart to get bigger? Do we need the charts to look a little bigger here? There we go. Let's move this over. There we go. All right. So S&P 500 is at the 200 moving average on the daily chart. It is holding up. We're headed into earnings season, right? We're kind of in it. Earnings growth is higher. I'm going to go through some charts, the chart deck, to show you that we should be ripping higher. We should be retesting 436 on the SPY, right? If you look at S&P SPX, we're probably coming back up to this 438 level, right? I don't know, maybe not. I mean, we do have some pretty strong, big mega cap earnings coming up. Here are the Qs. The Qs look a lot better than the S&P. Why? Because it's technology. Technology stocks lead the market. We know that. Technology stocks are going to lead the market. What up, Yassine? PMI, don't you think? Yeah, we're going to talk about the PMIs, right? We are going to talk about the PMIs. First, big story here. Look, Bill Ackman, one of the bond vigilantes that we had been talking about for a while. Bill Ackman is a bond vigilante, right? As in he's shorting the bond market. Well, he covered his short. He covered his short finally. Let's actually do this. He covered his short. So what does that mean? Bonds have peaked. The bond market has peaked. This is the signal to get the stock market back up. Bonds have peaked. Well, actually, we don't know that, but we're going to keep calling the peak here. Are we at peak? Nope. Are we at peak? Maybe. The bond vigilantes are covering. Why? Because the war is accelerating. The war is picking up, right? Maybe it's not too bad. Maybe it just stays in the Middle East. I don't know. But either way, the bond vigilantes are starting to cover. You see the dollar started to weaken. Today, it's pretty strong. I think, dollar and yields are really going to come down to what the Fed says coming here on tomorrow. No, Thursday. My bad. No, it is tomorrow. I think it is tomorrow. And let's remind you what the Fed has been saying about the bond market, right? What has the Fed been saying about the bond market? Are 30-year yields peaking? Maybe, maybe not. Look at 10-year. 10-year looks like it's peaking. This is very bearish pattern. The RSI is pretty much overbought. It's going to come down. But let's remind you what the Fed says.
There are those who suggested, including some colleagues in the Fed, that maybe the bond market is doing part of your job for you. Is that the way you see it?
I would say it this way. The whole idea of tightening policy is to affect financial conditions. And to the extent higher bond rates reflect, they do. They're producing tighter financial conditions right now. So that's how monetary policy works. That's literally how it works. In principle, as long as bond rates are going up for some reasons, and they're not going up just because they expect us to do things, so that if we don't do them, they'll come right back down. And we don't think that's the case.
Right, so bond yields are doing the Fed's tightening for it, which kind of signals, hey, I think the market has peaked here. I think the market has peaked when it comes to yields, right? The bond market is peaking on yields. Look at oil. Oil coming down. These are the major macro forces. Yields, oil, right, and the dollar. And yeah, the dollar looks kind of bullish. It's still above the 105.50 level. That's still bullish, right? If you're bullish on the dollar, you want it to stick above that level. But there's been some short-term weakness, and if yields keep weakening, then the dollar might actually roll over here. We might actually get that rollover. Okay. And oil's making another top here. Looks like oil's going to roll over too. This is really what's going to cause the havoc. The oil is the how do we set the wild card here? It is the wild card. If it breaks out, it's not going to be good. It could be forming a wedge pattern. It could be, making a new low. It could be done with the move. If we look at the trend, it's still trending up. So it's not, we're not out of the woods yet. We are not out of the woods yet. The dollar's still flagging, right? Not out of the woods yet there. Actually coming into the 50-day moving average. Maybe it is a little more bullish. But if yields have peaked, that's going to be good for the market overall, right? When you look at the Qs coming right back up into a big level. The Qs are coming into a big level here. Okay, what else do we have? The Dow, Dow double bottoming. It looks like trash, whatever. I think the big story, we all know it's going to be Bitcoin, right? Bitcoin starting to break a 12-month resist. No, this is what? 12? No, this is longer than 12. May, August, September. This is pretty long. This is a year and a half. It's breaking out. It's at the top of the range, right? Front running the crypto, front running BlackRock, the institutions. We're front running the institutions here. We are front running the institutions. What up? Today's kind of mild. Yeah, today's a little mild. I like it. Well, those are the technicals. I'm looking here. I'm trying to get Chainlink. We'll come back to this, right? We're going to come back to this because I want to deliver the macro for you guys. It's kind of the specialty. We'll look at the macro and the technicals, but check out this chart right here. I'm still bullish on Chainlink. I'm actually trying to get some more down here at 970, right? I want to get it under 10. I want to get it under 10 before Bitcoin breaks out again and starts lifting the market, before Ethereum breaks out again. And if you are looking at these charts for crypto, you want yields to come down, but crypto really hasn't cared. Crypto doesn't care about yields, doesn't care about the dollar right now. The tokenization thesis is here. The Bitcoin ETF is here, right? It's coming at any moment, today, tomorrow, next week, I don't know. But we are going to get earnings in about a minute. We're going to see the big tech earnings and how that plays out. Let's look at the macro. Let's go over the story, right? Well, let's go over the macro story, because this is the real story, keeping track of the market, what we're seeing. All right, that's it. Now we're going to get earnings. We'll see how these earnings turn up. Let's go to see what Microsoft does. They should be coming out in a second. I might even save this. We might even save this. Let me put CNBC on. Let's put on CNBC so we can get those live earnings. I'm going to keep it here in the corner on YouTube, and then we'll get those live earnings when they do come out. Make sure we cover that. Ooh, Microsoft exploding already. All right, let's just go ahead and look at it. Wow. Wow, big move by Microsoft. Here goes the Qs. Here go the Qs. Pretty strong signal. Yeah, we got earnings today. We got a big lineup, man. We got a lot of data. We got the Fed speaking. These are the biggest 2 weeks of the year. I think this closes out. This confirms the Santa Claus rally, right? This is going to confirm the Santa Claus rally. Let me throw up those Microsoft earnings. We're not even going to get to the macro yet because earnings are out. Look at Microsoft pumping. 340, up 10 bucks. A lot of shorts probably covering. The market's up. Here in the left-hand corner, we got the S&P pushing up. No, I'm sorry. That's NASDAQ futures. Let's just go NASDAQ QQQ. What are the actual earnings, though? I don't know. Okay, earnings alert. Is this Microsoft? All right, cool. Results are out. Let's go ahead and stream these. Let's go ahead and stream these results. I'll make sure to pause it. We'll be a little delayed, but that's fine. If dollar goes down, yields go down. Actually, the dollar is decoupling right now. You're seeing the dollar's kind of decoupling from yields at the moment because the war. So it's kind of tricky. The dollar should be spiking with the war and yields be coming down. That should be it. But we'll talk about that later. That's not actually the case right now. The market is changing a little bit. All right, let's look at these. Let's hear these earnings. Let's see what's going on here. Let me know if you guys can hear also.
Us about where investor sentiment is.
Yeah, so just from a mechanical point of view, obviously these companies are going to be crucial because they dominate the indices. So,
or $9 billion.
they did look a little bit better.
All right, here we go.
A number of large cap outperformance today.
Adam,
Yep.
got to interrupt you here. Microsoft's numbers are out. The stock is popping after hours. Let's go to Steve Kovac with the numbers. Steve?
Yeah, John, it's popping because of beats on the top and bottom line. Solid beats at that. Let's go over EPS, $2.99 versus the $2.65 Street was looking for. Revenue is also a nice beat there, $56.52 billion versus the $54.49 billion the Street was looking for. Digging through the report now, John, get you some Azure numbers and other stuff to look at in a bit.
Well, Adam, I was just in the process of asking you about this. We have the stock, at least on this initial headline, moving higher by more than 5%. How much is this going to matter, once again, for the markets potentially tomorrow?
I think it's crucial. So like I was saying, the first week and a half of earnings season was underwhelming. The numbers that we got this morning were
Okay, well, that was,
a lot.
I mean, that was trash. All they said, they didn't really give us any details. Looks like Microsoft beat top and bottom line. Yep, year over year up. So they last year 230, a year ago 235 cents. Earnings per share, they're up at 299. So that's a pretty good beat. Sales 56, expected 51. Beat top and bottom line. It looks like please CEO sounds alarm on video game industry. What is this? Okay, here we got another earnings report. I think, okay, here's the real report. Here is the real report. Let's rewind this.
However they trade will have enormous.
How's that
impact
sound?
on
Let me know if
broader
that sounds
S&P
working.
NASDAQ.
Okay, we've got earnings from Texas Instruments as well. Christina Partsinevelos has those for us. Christina.
Drew, you were seeing a mixed report. Revenues coming in less than anticipated at $4.53 billion on EPS of $1.85. That was a beat. The Street was anticipating $1.82, but the weakness is really coming from the Q4 outlook, which came in lower. The range for EPS and revenues, both lower than what the Street was anticipated. And just one line, the company saying revenue was flat, sequentially decreased 14% from a year ago. Automotive growth continued and industrial weakness broadened. So those are the two issues right there. Q4 outlook weak, mixed report.
Right. There you go, mixed report. So Microsoft beats the Mag 7. We already said this. The premium stocks are going to win here. We do believe the premium stocks win here. So Texas Instruments, which is a semiconductor, missed. I mean, they did beat EPS, but it does look like, dang, we got a lot of earnings coming in, but it does look like they missed expectations. Guidance is lower. Ooh, Alphabet. All right, we got Google next. You guys ready for Google?
To the strike. All right, we've got more earnings before we go there. Alphabet. Deirdre Bosa has those numbers. Hey, Dee.
Hey, Morgan. Alphabet shares, they are down more than 6% in the after hours, though it is a beat on the top and bottom line. Third quarter revenue coming in at nearly $77 billion, exactly coming in at $76.69 billion versus $75.97 billion. So a beat here. Also on the bottom line, EPS coming in at $1.55 versus $1.45 expected. What may be hitting the stock are these cloud numbers, guys. I'm just going to give them to you because I have them. 8.64 billion was expected in terms of revenue. 8.41 billion came in. That is a little bit of a miss there and could be the reason for some of the weakness. Remember that Google does not give guidance. We'll continue to dig through this and bring you more. Back to you.
Okay, those shares are down 5% right now.
Google does not give guidance. Okay, well, that wasn't good. You got Microsoft beat. You got Google on the weakness. So it looks like here's the reading for Google. Let's move this. Google missed. Okay, Google. Microsoft up. All right, so EPS for Google came in at $1.55 per share consensus. So they did beat EPS, revenue 76 billion versus expected 75 billion. They beat top line. Did they beat bottom line? I think they beat top and bottom line. Operating margins 28%. They don't give guidance. They don't give guidance. Right now, Alphabet is down, and after hours, Microsoft is up. So a lot of mixed earnings here. And again, you could get that sell the news, buy the rumor. Google in a rising wedge. Maybe that's what it is. The actual technicals are pretty bearish. If we get buyers, yeah, Microsoft was looking pretty bullish there. Alphabet shares dropping on Q3 earnings. Let's hear what this guy's saying.
They implied on the last quarter that the AI ramp for this fiscal year would be a little bit more back-end loaded. And so I think people kind of lowered their expectations on Microsoft heading into this quarter versus Alphabet. And that kind of explains some of the discrepancy that you're seeing in the after hours price action.
Yeah, it looks like cloud revenue for Microsoft, Santoli, up 25%, and it says server products, well, revenue in intelligent cloud was $24.3 billion. That increased 19%. Server products and cloud services revenue increased 21%. That was driven by Azure and other cloud services revenue growth of 29%. So certainly a juxtaposition potentially to be had here between what we're seeing, at least in these early combing through results from Microsoft versus Alphabet at a time where...
So they just missed on cloud revenue. Google missed, I think that's their, second, third biggest segment. I'm not sure. I'm not a, Google enthusiast, but looks like they missed. I wonder what their YouTube look like.
So I think that's the difference. Microsoft might be considered a little more the bellwether for what the overall industry might be expecting. And, it's always seemed to me that you pay close to 30 times earnings for Microsoft if you choose to, because...
So far, Microsoft up, Google up. I mean, they did beat, but they missed on that. Microsoft, okay, let's see. Yeah, Google down, Texas Instruments down, Microsoft up. That's what it looks like here. Visa, there we go. I wanted to see Visa because this is...
Jump out to me. Of the major
Visa on. Okay,
categories,
Visa.
productivity, business process.
Visa is going to give us a little insight onto the consumer because we're going to look at the macro in a second, the setup here while we're getting earnings.
The most in intelligent computing, but even more personal computing, where Windows, the PC-related business lives. They beat by almost $1 billion versus expectations. But looking at some of the smaller divisions, LinkedIn in particular, LinkedIn revenue was up, but just 8%, and perhaps speaks to why there might be some why there is some belt tightening there with Microsoft having announced some layoffs, even in engineering in LinkedIn, perhaps trying to drive efficiency even as there is...
Okay, let's go. I want to see Visa. So far, we got Google down a little bit. We'll see if Google continues. Microsoft's still moving up in after hours at the moment. Google's down, but Google did have a crappy... Let's see what the trend looked like. You said rising wedge? It didn't look that bad. I want to see Visa. What do we got for Visa? See... Okay, here's Visa. We're going to look at Visa. We're going to hear about Visa earnings right now. Let's turn this on.
Visa earnings out as well. Kate Rooney has those numbers. Kate?
Hey, John, so it's a beat here for Visa. They're also announcing a 16% dividend increase and a $25 billion buyback. Getting to some of the numbers here, adjusted EPS coming in 9 cents better than expected at $2.33. Revenue of $8.61 billion. That was a beat here as well, up 11%. Year over year. They are giving guidance for the fiscal year. As I said, this is Q4, so we've got some full year numbers here. They're looking for high single digit to low double digit revenue growth. Estimates were 10.4% growth for that revenue number. No EPS guidance. We've got a quote here from the CEO saying they're looking at resilient consumer spending. They also talk about recovery of cross-border travel. That is key here as well. Payments volume up 9%, and then cross-border, that international business, up 16% here. John, Visa's up more than 2% after hours. Back to you.
Okay, Kate Rooney, I'll take it from you, and that's certainly been a theme we've seen since at least the last quarter with the credit card companies, the Visas and MasterCard.
Hey, consumer spending, right? They got $1 trillion. We're actually going to look at that. I think those are the big, who is this? Who we got next? Snap? I guess everybody wants to see Snap.
Profit of 2 cents per share rather than the
Oh, they're
4
up.
cent per share loss that analysts had anticipated. We see Snap shares are up 20%, or now about 19% in after-hours trading. Now, digging into this, revenues beating expectations, coming in at $1.19 billion rather than the $1.11 billion estimated. The company is saying that they are seeing the impact of improvements they've made to their ad platform boost results faster than anticipated. Daily active users were pretty much in line with expectations. Fourth quarter guidance looks a little bit mixed. Snap projecting fourth quarter revenues in a range of $1.32 billion to $1.38 billion. That is ahead of the midpoint of $1.33 billion that analysts are expecting. But Snap cautioning that profits could be less than Wall Street expectations, giving a range of 65 to 105 million versus the consensus 103 million estimate. Snap flagging uncertainty around the Hamas-Israel war, saying it caused some brand advertisers to pause campaigns. The company also announcing a $500 million share repurchase program. Guys?
All right. Those shares up 16.
Buying back shares. That's going to be the story here. Beat top, bottom line. Here comes the consumer also buying back shares. We'll see who else buys back shares. All right. So I think those are the big earnings. I know there's some other earnings coming out. Let's double check what the other earnings are, but I think those are the big earnings. We also have Visa saying that, communicating to us that consumer spending is still pretty robust, right? I think that's going to continue. Middle East war. Okay. Oh, I got to watch what I say here on TikTok. Last time I got banned for even talking about it. So let's be careful what we say. All right, so yeah, today's earnings, we got Microsoft up, Google. So Microsoft was expect here. Let's just show this on the charts because I think those are the big earnings that are done. You got Verizon. Was that this morning? Raytheon. Those should be straight. Coca-Cola already reported this morning. Daily active users. Who cares about Snapchat unless you guys are Snapchat guys. All right, let's switch over. Let's take a look at this. So here's what we got, and I think that's all we need from CNBC for now. All right, so here's what we got. Microsoft, EPS, consensus 265. They beat, right? They beat on the, I guess you could call that bottom line. Revenue top line, 54. They beat that 56. So, Microsoft is killing it, and stock is up. It's a $2.5 trillion market cap. Here we go. That's going to pull the S&P higher tomorrow. But Google down. They did beat EPS. They did beat bottom line. Top line, which is the revenue, they barely beat it, but they did miss on cloud revenue. I think that's what's hurting them. Their guidance might be lower. Visa barely beats consensus on the bottom line. But let's see, top line. Oh, no, they barely beat revenue, but they did say, hey, consumers are robust. And I think, again, we're going to keep seeing this robust consumers. And we'll tell you why, the actual fundamentals to that. Maybe not till until February. We'll see. So Visa's up, and that's a big cap. That's a $500 billion company. So these are some major big caps doing well so far for earnings. Coca-Cola this morning beat top and bottom line. Yep. And they also said that they're getting a lot of demand for some of their products. Who knows what they are? They do a lot of stuff. Verizon beat. Man, we're getting a lot of beats here. Earnings are set to go higher also, just FYI. Semiconductor, they missed. Raytheon beat, of course. I think those are Waste Management. Those are all the big. So we got a couple more. Tomorrow's Meta. That's going to be big for Meta. But let's go ahead and answer your questions, then switch it up because I want to go over the macro and some of the technicals and, think this through here. We're going to start with, China. China's credit impulse is starting to pick up. 3-month lead. Looks like China's going to start stimulating even more. Okay, good. Okay, so Snap's up. Google. Let's see what we got on Google. Google is down, man. Google is tanking. I bet the buyers step in, though. It's at the trend. It is at trend. That is a rising wedge. Microsoft is, Microsoft is a little better. Microsoft's blowing up. It's breaking out of a wedge channel. All right, let me change this up. Okay, what else we got? I think Mag 7, Microsoft, Apple, Amazon. Let's pull this over here. Amazon. Bullish technicals, Google bearish, Nvidia, Tesla neutral. Tesla already moved from neutral to bearish. Yes, Tesla. I actually think Tesla looking pretty good here. We'll see how it moves tomorrow. Would you say Slime Z? This Q4 earnings feels like Q2 earnings earlier this year. Well, this is actually Q3 earnings. We're in the fourth quarter. We're entering the fourth quarter, but these are Q3 earnings. I guess it's kind of confusing. It depends how you put it. So January we'll get Q4, right? So we're kind of looking back here. That's the thing. Earnings are looking back. So you really want to hear the guidance. I think that's the most important thing. What is guidance looking like going forward from here? Meta is also bearish. Oh yeah, we read that. My technical view. Oh, you got your technicals on the Discord. Cool. All right, cool. Yeah. Let's put this up here so I can timestamp this. Stocks can rise in a higher rate environment. See which one do we want? Recession of the mind. Let's go with recession of the mind. Okay, recession of the mind. So we're gonna start this segment here. 26 minutes. We're gonna start the actual segment. This is a recession of the mind. Okay. What do I mean by that? Well, see if we can open this up a little bit. This was the PMI data this morning, right? This PMI data is basically the output, economic output from the S&P. So economic output from manufacturing and from services, manufacturing output, it has been in recession, right? Services have already been pretty positive, and now we're getting manufacturing start to recover. So you can see the numbers here, 50, we're at 50. So 50 is expansion. These are supply chain managers. This is a sentiment indicator. And now CEOs or supply chain managers are starting to become positive on the economy going forward. Their output is increasing, whether it's employment, new deliveries, production, new orders, whatever it is. We're getting services output, manufacturing output picking up. Where is the recession? Where is the recession? Where is it going to come from, right? What recession? Next chart. If we look at employment, employment is like the key for a recession. If unemployment spikes or employment falls off in general, people don't have jobs, they can't spend more, you're pretty much done, right? But if we look at 6 segments of employment, what do we get? Well, this chart looks kind of crooked. Is it just me? Maybe it's just me. Low unemployment rate. We're still at 3.8%. Let's zoom in there a little bit. We're at 3.8%. We're still, we're there. Falling claims so far. The recessionists, it's just not happening. Initial jobless claims are falling. People have jobs. Positive payrolls, well, because people have jobs, right? And those payrolls are coming out stronger than expected, which you would say, oh, the Fed's going to keep hiking. I don't know. The bond market is doing the work for the Fed, and we're not getting wage inflation here. Easing wage pressures. The average hourly earnings are still moderating. They're still easing. They're still kind of elevated, but they're still easing. This is better than inflation, though. You want this up because people's wages, right? Employment wages are higher than inflation at the moment. Growing labor force. The labor force is growing. So if that's the case, then you're going to be in good shape here. You are going to be in good shape here. Let's see. So to wrap it up, an increase in productivity, right? So the output of goods and services per hour worked is increasing. So if you get, strong employment, people have jobs, they keep spending. Oh, inflation. No, because average hourly earnings are down. Productivity is up. That can absorb inflation. Employment remains robust with productivity increasing minus wage pressure, no inflation, right? I don't want to say no inflation, but there is no, there's no red herring. There is no signal that inflation is increasing according to the employment report. And we'll see what Powell says tomorrow. I believe it is tomorrow. We'll double check on that. And then also I put together a little chart for you guys. If you want to see, the consumer is not collapsing. That's what this is. Let's break it down here, right? If you want to see the charts, go ahead and jump onto YouTube, link in the bio, link in the description. First, household wealth is increasing. Okay, so U.S. household wealth is actually, median and mean average is higher than 2019. 2016 to 2019. So people are wealthier, right? Households are wealthier. You can point out exceptions, but the world does not move. The world does not run off exceptions. Okay, this is the data. I don't trust the data. Well, then what do you trust? then what do you trust, right? I don't know. Maybe you don't trust all data. That's fine. But this is what the data is showing us. Household wealth is greater than it was in 2019. Disposable income got revised up $1 trillion, right? $1 trillion. Well, not up $1 trillion, but there's still excess savings, right? Actually, this shouldn't be disposable income. It should be excess savings. Same thing, whatever. I guess you can still quantify it. The market likes it. So there's more savings, right? Okay, what about the delinquencies? What about the credit card delinquencies? Well, you know, if you look historically, credit card delinquency levels have been rising. Don't get me wrong, they have been rising, but they're still at historic lows. Going back to 2001, right, at the beginning of this chart. So they're still at historic lows. Household debt is, oh my God, household debt is up. Well, as a percentage of disposable income, household debt is actually down. It's actually down. Going back to, what is this, 1990? This is like the this is 85. This is early. So we're still at historic lows for household debt as a percentage. Anybody can look at the nominal numbers and say debt is at all-time highs. It doesn't matter. What matters is, what are your down payments and how much income are you taking in? Okay, it's a math trick. It's a headline to get you scared that we're going into this deep recession. I think we are in a recession, but it's not as dire as people put it. And I'm going to explain why, to the psychology of the market, right? So household wealth is better than expected. People still have excess savings, right? Credit card delinquencies are at historic lows. Even though they're still spiking, they're still not that high. Household debt as a percentage of disposable income is at historic lows. Credit card debt as a percentage, credit card debt is at all-time highs. Debt is always at all-time highs. Okay, the debt has always been this is always my argument. Debt is always higher. Unless you get a collapse or something breaks, then debt comes down because the bubble pops. But debt is always at all-time highs. The question is, what percentage of disposable income, how does that stress out the economy? And as a percentage of disposable income in blue, it's pretty low. So is this a recession of the mind? You see it on the headlines, recession. It could be the political parties. What are they saying? Oh, we don't like the people in office, which goes both ways. This is a recession. The economy is not that strong. So you can't, look at the data. Look at the data, understand the data a little better, right? So why is it that people are so negative? Oh, we also missed these charts, right? This is recently retail sales up for 3 months in a row. 1, 2, 3. Well, I guess it's kind of down, but they're still up. They're still positive. Retail sales are still picking up. You saw Visa just report that consumer spending is still pretty strong. Okay, month over month. Hey, is this the right chart here? Why does this look like the same chart? This is not right. Oh, I see what happened. Okay, well, that was a mistake. All right, well, year over year is up 3 months in a row. I know that. All right, so recency bias, right? This is the other part of it, of the recession of the mind. Here, I'll take that off. It's kind of big. Recession of the mind here. And let me explain this. Let's hear this out if you're just listening. I think recency bias has investors psychologically scarred, right? Psychologically scarred from 08 and 01. Let me say it again. Recency bias. So when they think, recession, you hear a recession is just a slowdown. Okay, I'm not saying it can't get worse, but a recession is a slowdown. It's not a financial collapse. There's not always a financial collapse in a recession, right? S&L crisis in 1991, it was not a financial collapse. It was a recession. And we can argue we've been in recession. So why all the fear, doom, and gloom? Recency bias. Investors are scarred, and these are usually older investors. They're scarred from 08 and 01. They expect a huge financial collapse. I just don't see it. And 2, boomers, right? Baby boomers. Why is there so much excess cash? Money market funds. Why is nobody buying bonds? Well, boomers own most of the wealth by far. It's not even close. Okay, baby boomers, right? This is not a knock on baby boomers. I'm not knocking you guys. You guys are smart with your money. You guys understand history, but you're also kind of blindsided by the upside, right? All this fear blinds you from opportunity. Chainlink's up 100%. Okay, you're not going to look at Chainlink. You're not going to believe any of that stuff because you're not a tech guy. You're older. You've made your money. You're looking for safety. You're not going to take risk. Boomers own most of the wealth, and we know with age comes pessimism. The older people get, the more pessimistic they come. Oh, don't do that, Charlie. Hey, this is going to go wrong. Hey, you better watch out there. And That's needed. You should be skeptical. You should be a little more pessimistic, but you also must understand the pessimism is going to keep you from seeing what could be there. Why? They've already made their money. If you're young, you know, you're not going to make any money investing in bonds. You're not going to make any money buying S&P index. Stay safe, Charlie. Okay, well, inflation outbeats my returns. Great. Right? And for the most extreme baby boomers, what is it? The end of the world is coming. Financial collapse. You hear it all the time. Buy gold, buy silver. Who is it? Peter Schiff. Buy gold, buy silver, buy canned food. Shout out to my mom, but she's always reading this stuff. Oh, you better stack up on canned food. It's coming. The lights, the energy's going out. The blah, blah, blah. But that is the narrative that they pitch, the baby boomers, because they already made their money. They want you to buy gold because they own gold. For one, gold is going nowhere. It's where it was in the 1970s and 1980s. We can look at the damn chart. Gold ain't doing shit. It ain't doing anything. Buy canned food. Get the hell out of here. Canned food is toxic. I'll take my risk. Right? You don't go on a journey without risk. You don't become anything without risk. Don't take stupid risk, but you don't do anything without taking risks at the right time. This is the opportunity. The market is down. Everybody's pessimistic. Everybody's negative, right? The old age doom and gloom, perma bears, everything's going lower. But if you look at the actual history of war, Vietnam, the market went higher. Gulf War, market went higher. Afghanistan War, market went higher than lower. Why? Because you had, you had other stuff hit the market. After the invasion, after the Afghanistan invasion, we basically got, we got what, 9/11? That's weird. 9/11 came after. I'm not so sure about this chart. It looks like we had an invasion. Okay, there was the invasion, then 9/11 hit. Whatever. Anyways, that's one, right? That's one. Iraqi war, market went higher. Crimea, market went higher. When Trump, I don't even know if I can say his name. When launched that rocket at the, how do I say this without getting banned again? At the Middle Eastern general, blew him up, market went higher. Hopefully I don't get banned for that. What else did we see? Ukraine, the Russian-Ukraine war, market went lower. Well, yeah, because the Fed just started their hiking cycle. And that caused inflation to go higher. Are we looking at inflation going higher? Are we looking at economic activity rollover? What is economic activity? It is, dude, I'm building a course. You need to know how economic activity runs if you care about understanding the markets. I don't need to know that. I'm just going to listen to people on Twitter. This is what front runs the market. It is manufacturing. It is services. It is new orders. There's under the hood growth that is taking over. And a lot of people don't agree with me. That's totally fine. But I'm going to take my risk here, right? Here's the fear. Here's the fear. Look at this is JP Morgan, right? I'm sorry, JP Morgan. This is Bank of America, does a survey, and let's get the rhetoric on the side. Cash levels reflect, this is basically cash levels reflecting that investors are bracing for something that just never came. They're still waiting for the recession. It's coming. It's coming in December. It's coming in the third quarter. It's coming in the fourth quarter. Well, it's coming next year. Well, it's coming in 2026. Maybe it does. Probably at some point. But look, forward looking, we're not seeing the recession. It's just not coming. In 2009, there was a black swan event. In 2020, there was a black swan event. In 2023, today, you need a black swan event to really crush the market, and we're not seeing that. Right? You don't sit there and brace for stock. You want to be here in 2009 waiting in cash for another black swan event where the market's up 1,000%, NASDAQ's up 288%. We can go over the actual technicals of why rate hikes are actually, the pause is actually pretty bullish. We can go over that, right? What do you disagree with? What's actually going on here? What is that? Hey, thanks for the thumbs up. I didn't even know you could do thumbs up. Whoever did that, let me know who it was. It's kind of interesting. Anyways, yeah, so cash levels are reflecting that investors are bracing for something that just didn't come. Okay? Stocks have proven that they can rise in a higher rate environment. This is not the chart, though. Let me go to the chart, okay? 2016 to 2018. Fed raised rates 180 basis points. Bond rates went up 180 basis points. That's when you hear yields are up, rates are up. That's the bond market. Rates come from two ends. The Fed funds rate, that's a 24-hour rate for banks that doesn't directly hit the market, but it does, influence longer term rates. Longer term rates are going to be on the bond market. This is something you want to know, how it works. Those bond rates were up 180 basis points and the S&P was up 35%. And there's reasons for that. Fiscal spending. The government is spending. It's so, well, if it's productive spending, it's okay. If it's not, if it's just direct checks, you're not going to produce anything. But if you're spending into the manufacturing economy and each labor, labor costs are going down and goods and services are picking up, that's good. You hear, oh, the government is spending, inflation. Okay, from 2010 to 2019, the government spend, the debt went up and there was no inflation. Explain that. You can't. Because productivity was fine. We didn't have broken supply chains. Supply chains are starting to heal now, right? So 2016 to 2018, rates were up, the market went higher. But they'll tell you that the market cannot rise with rates this high. Yes, it can, because it is resilient. Just not all the play. It'll be in the premium stocks. What about 1994 to 1998? There was a labor shortage. The same way there is a labor shortage today, there was a labor shortage and the market went higher. And guess what? The Fed rate hikes, the Fed funds rate was above 5%. It held above 5%. Bond rates were above 5%. And the NASDAQ was up, technology 275%. Why? Because when there's a labor shortage, that labor comes from technology, industrials, internet, the internet boom, right? Whatever it is, this takes over. And now we have AI, and now we have blockchain, and now we have EVs, and now we have energy storage, and the market is going to roar higher, right? I'm not saying go buy stocks. I'm saying think about it. I'm not going to tell you what to do. I'm just letting you know. I'm just passing on the other message while everybody's super bearish and negative, right? And this is why I get it. I get why you're negative. The Fed started right. Listen, the market has weathered the storm. The fastest hiking cycle in history, yields, bond yields, and the Fed funds rate, the Russian-Ukraine war, the Fed says we're going to stay higher for tighter for longer, and all you, higher forever, you guys are buying into that, higher forever. He's playing you. There's not going to be higher forever. Well, rates are going to be high forever for the next 20 years. What the hell are you talking about? I see these dudes, these mainstream guys talking about rates are going to be, dude, you're speaking your book. You're speaking your book. Rates are not going to be up forever. Even if they are, that doesn't mean the market's down forever. Okay, if you go back in history, it was up. So anyways, higher forever is what they believe. They're getting played. The Fed is speaking to get the bond yields up. The Fed is trying to get yields higher. It's trying to get the mortgage rates higher. It's trying to cool down the economy in certain areas, and it is happening. And guess what? That cooling did happen, and we got the regional banking crisis. But what happened? This should have been your crisis. This was your crisis right here. But what happened? The Fed stepped in with QE, which they didn't have QE in 2008. That's when they started it. There was no QE in 2001, but QE came in. That was the banking crisis, and we weathered the storm. The UAW strikes, the market's up. Israel-Gaza war, right? We're looking, I know, I get it. It's bad. Everything looks terrible. It looks pretty bad here. But again, the market is pretty resilient in certain areas. We're seeing Microsoft explode in earnings. Earnings are starting to rise. And that is the next segment here. That is the next segment. Future earnings growth is rising while flawed indicators are weighed down by overly cautious CEOs. Let me say that again. Forward earnings growth is rising while supposedly forward-looking indicators, the LEIs, those are negative. Those are saying we're headed to a deep recession, but it looks like it already went into recession mode. It's already at the lows. What is the answer to this? We have no answers. Nobody's told us, well, what is the real answer? The answer is, right? I'm not saying I'm 100% correct, but I think it's just that people were overly cautious. Shout out to Tom Lee. Tom Lee's been right, and I'm going to take his word for it. It makes sense to me. CEOs were overly cautious. They're citing recession. That's actually coming down, but they've been citing recession. They're overly cautious because the Fed communicates a lot sooner now. The Fed has never in history communicated this much. They're on 24/7. Not 24/7, but every week the Fed is speaking. We're going to be higher for longer. We're going to tighten rates. We're going to do this. So they're speaking it into existence. They're manifesting tighter conditions. And the bond yields rose and we're getting tighter conditions. The dollar's up, we're getting tighter conditions. Oil's up, we're getting tighter conditions. The stock market sold off, you're getting tighter conditions. And so they spoke it into existence. So of course these CEOs, their sentiment is negative because they're preparing for the worst. But did we get the worst? No, it didn't happen. Preparing for something that never came. And now GDP growth is rising, right? We're above 5% expected in the third quarter. It is a Santa Claus rally. We're seeing consumers still spend. Visa just said consumers are still spending. It's still pretty robust. We are in the US where it is seasonality. Halloween, you know, you guys all know somebody going to a Halloween party, going out there buying Halloween candy for kids and for, you know, social reasons. You know how it is, 304s. And they're buying costumes, right? And then guess what? 304s, get your calculator, put it in, turn it upside down. All right. So people are going to keep spending. You're going into Thanksgiving, they're going to keep spending. You're going into Christmas, they're going to keep spending. So spending is going to continue. Oh, but credit card debt's at all-time highs. But guess what? Versus incomes, it is still historically low. What about household debt? Well, it doesn't matter because this, you know, there's still $1 trillion of excess savings. But eventually next year it's going to roll over. But look at who's in charge right now, the White House. You think that guy's not going to pump? You think if consumers slow down and start defaulting, he's not going to pass out stimulus checks? Well, that's going to be inflationary. Well, it depends where the economy is at that point. We'll address that when we get there. But this shows us that earnings growth is picking up. GDP growth is rising. Well, actually, that's not it. Well, where's the GDP growth? Here it is. Atlanta Fed GDP picking up. Corporate profits are still robust. So despite the rate hikes in blue, right? But despite the rate hikes in blue, what do we see? Interest payments for S&P 500 companies or companies in general. What is this? BE, net interest of payments, gross value added non. So corporate interest payments are falling while the rate hikes are up because they locked in low rates earlier, so the market goes higher. So even if the economy struggles, well, it's going to struggle in services because the consumer probably does slow without a payment check from the White House, without more cowbell, without more stimulus. But fiscal stimulus is going to pump the manufacturing sector. And if we have a war, there's still going to be more activity happening. That means more jobs. So if you're going to print money, if you're going to create debt, make sure it's productive, Mr. You know who. I don't want to say it because I got banned last time. And inflation is falling. And inflation is falling. Headline in core, falling. Oh my God, inflation is so hot, it's so sticky. Okay, it is sticky. I get it. It's up 20% from 2020. Right? If you compound it, it's up 20%, but that's why you invest in assets. Bitcoin's up 10x and it just broke out. That's why you invest in assets, because you're not going to win with wages. But on a year-over-year basis, core is only up 4%. It is falling. It's going to be in the threes pretty soon. Headlines up at 3.7%. It's been sideways for 2 months. Oil is the wild card. Okay, oil's probably going to come down. Motor vehicle, right? Listen, shelter in motor vehicles is 2/3 of inflation. Shelter in motor vehicles is 2/3 of inflation. Well, they're falling. Motor vehicles down, right? Back down to normative levels, falling quick. This is inflation. This is not the actual price. This is the inflation versus the market. Stop thinking of it on your, this is not about you and how expensive it is. This is about how the stock market views inflation. It's going to go higher. Invest in assets. Real rents are falling because there's more multifamilies being built. Fed shelter is rolling over and due to continue to roll over. So inflation is going lower. And there's some indications that historic CPI is actually at 2.8%, not at 2%. So when the Fed says, oh, we got to get to 2%. Well, historically from 1982, the core inflation number was actually 2.8. It was actually 2.8. So are they fooling you? Yes, they are. Not on purpose. They're using expectations to get, to get conditions tighter. It's smart. It's pretty smart. It's a tough job. Good luck being a Fed governor. So those are the charts. Those are your charts. What is your response? What is your response? I rest my case. No, I'm just kidding. But yeah, that's what I got. That's what I want to deliver for you guys. I really get into it. So let's get to these. I'll throw on the charts and I'll get to your comments. Let's get to some of these comments. First, I'm going to start with the YouTube. If you want to make a comment, go ahead and jump on YouTube. And then Carbides, yes. Let me pull up your technicals. Let's pull up your technicals. I see you, AC. Government spending is always less productive than private spending. Very true. Very true. Government doesn't have the incentives of efficiency that private parties do. 100% to the point, right? There's an untold story of technology-induced deflation forces in the market. Yeah, AI is literally deflationary. That's what nobody sees. These old baby boomers who are stuck in their ways, and I get it, young people are also blind to a lot of stuff, but you guys are also, you guys, and I'm just kidding, they're also blind. Everybody has, you know, everybody's blind to something, but they don't understand AI. They can barely fix their computers. They have all this wealth. They have no clue how it works. And that's fine. They made, you know, they did what they had to do, but they don't see the productivity of deflation. Plus, when you head into a labor shortage, technology takes over. There's a chart that shows technology explodes just like 1994 when there's labor shortages, right? There's a lot of that. So yeah, we're going to see deflation over time. Plus, older people who retire, they spend less. You know, they don't know when they're gone. They don't know when the end is near. So they're going to spend less. They're not going to, that'd be the worst situation psychologically, to overspend when you don't have a job because you're old. Yes, sir. Either take the risk or lose the chance. 100%. What would a breakout in junk bonds mean for equities? A breakout in junk bonds means equities go much higher because the credit the credit is being supported, right? You're buying equity debt. Junk bonds is equity debt. So high yield goes up. High yield goes up. HYG. I think it's HYG. Let's go to the charts. And if that goes up, markets go higher. Please don't tell me Chainlink broke out. Okay, good. Still waiting for it. Haven't got the signal yet. These are junk bonds right here. Junk bonds, high yield. They did break down, but they're not at lows from October, right? They're not there yet. Maybe they keep going lower, but we'll see. HYG, same thing. So if you get a bid in junk bonds, equities go higher, period. We're going to all-time highs. I agree. We're going to all-time highs this year. I mean, that's the setup. We'll see how earnings turn out. So far, they're beating top bottom line earnings. Earnings are getting beat at the moment. What chart you look at with the wars you shared on Twitter, just go to my Twitter. Just go to my Twitter, you seen? It's just all the wars. It's just a chart. So, I mean, somebody reposted it, and then I have the question, Israel-Hamas war. I think the market still goes higher. I would love to see us come to your live one day and hitting all-time highs and bank. Come to, oh, you mean like a what do you mean? What do you mean, Slimesy? What are you talking about? Come to my live? You mean like literally like get, you know, have a podcast? That'd be tight. Have a podcast. If that's what you're saying. Unless I read that wrong, can't read. I can feel it in my jujubes. Ricky Bobby. What a name. Ricky Bobby. Look at BMH. Oh, you're talking, I know what you're talking about. You're talking about Bukowski. You're talking about this, huh? I mean, I don't know what M2 is. I think you're talking about credit, equity credit spreads. Those are rising. So this is it's not a concern yet, but equity credit risk is rising. Why is, no, give me a regular line. Equity credit risk is rising at the moment. It's been rising since September. This was the banking crisis up here. So we're still far ways away. And look at half of this rise in equity credit. I think I'm answering your question. Half of this rise, just think about it. Let's use some logic here. And I'm not trying to put anybody down, but let's use some logic here. This chart, equity credit, it's a spread. It is basically, you know, the demand for debt. It's basically demand for equity debt versus demand for treasury debt. If the war is moving, you know, if the war is scaring people into treasuries and the shorts are covering, well, there's going to be more buying of U.S. treasuries. So it's not like they're dumping corporate debt. They could be, but it's more so that more treasury demand is coming into the market. So you're getting inflows of treasuries, and that's going to increase the BBB spread. Right? So unless it gets to really high levels, then, you know, I'm not too concerned. Or you get a spike, you might be a little bit concerned. But people are just piling into treasuries. Or it could be the bond vigilantes, which we talked about earlier. The bond vigilantes are starting to cover their positions. They're starting to cover the shorts. Bill Ackman, I think, Bill Ackman I think he just called the top of the market. And he's probably now long stocks. right? He's probably long stocks now. Who knows? He did this before in 2020. But I mean, we're oversold. Look at we bounced. We're moving higher. This is a bullish divergence, by the way. In carbides, which one? Signal me on Discord. Show me on Discord what the Mag 7. You want me to show the Mag 7 on Discord, or what? Let me know what you want me to show on the Discord. I don't see anything new yet. Maybe I'm tripping. Anyways, yeah, that's our Discord. If you guys want to join it, let me know. Throw your comments in the if you want to join the Discord, just let me know in the comments. All right. You mean Ackman called the top of the dollar? That is Doifer. Did he call the question is, what comes first, the chicken or the egg? Is it yields? Is it yields, or is it see if I can move this correctly. Is it yields, or is it the dollar, right? Who moves who? Typically it's been yields, but I think the move has actually changed here. Specifically because look at yields are coming down. I mean, rates are coming down, right? When rates are up, dollars up. Rates up, dollars up. But this time, rates up, dollar was down. And well, actually, no. Let's just put it on a line so we could see this a little more clear. Okay, that's stupid. That is stupid. Let's do it this way. TLT. Let's go TLT in the dollar. Let's take these off. So is it the chicken or the egg? So here's what we're looking at. Here's the divergence. Let's get that. Oh, here we go. All right. So typically when bonds sell off, the dollars went higher. Okay. The dollar's in orange. The dollar is in orange. This is, can you see that? Yeah, you can see that. So dollar goes up, bonds sell off, or bonds sell off, dollars go up. Why? I mean, duh, you're selling your treasuries into US dollars, right? Also, there's some type of risk, inflation. So the dollar goes up. And then when we switch over, you have bonds up, dollar down. So that's been the trend. That's been our trend, right? And then you have something changing here. You have something changing because you got bonds down and the dollar trending down. And now you have bonds up, dollar up. So something in the market is changing. I don't know what it is. I don't know if the chicken or the egg. We'll keep our eyes out. What could it be? What could it be? It could be that people are buying dollars as a safe haven and they're buying U.S. treasuries as a safe haven. That makes sense. Okay, the war is escalating. Let's stay in dollars and buy U.S. treasuries. Now, listen, here's the tricky part. Everything goes higher here. Everything goes higher. Dollar goes higher. Stocks go higher. Treasuries go higher. Everything goes higher together. Crypto goes higher. And I think that's what we're going to see here. If yields come down, which is basically you need bonds to come up. If yields can come down, it's okay if the dollar goes up. The dollar strengthens, stocks can still move up with the dollar strengthening, just not as fast because it's a safe haven. It's not the dollar's not moving up because stocks suck. What's happening is yields come down, therefore valuations and earnings go up for stocks. So stocks go up, bonds go up, dollar goes up. But you don't want the dollar to continue higher, obviously. The worst thing would be oil going up also. I don't know if that's very bullish. But if the oil is down or oil sideways, if we move sideways, or if the dollar moves sideways, we might be all right. So yeah, Bill Ackman, he basically called the peak here. That's what I saw. Did we have any other comments? Any disagreements? I mean, oh, here we go. We are not going all-time highs in 2 months. What up, Mexi? I mean, it's always a probability, right? So nobody knows. That's that's what you think. if yields come down and earnings growth continues, I think we do. I think there's a lot of buyers down there. We'll see. I've been calling for it. Maybe I'm wrong, right? Obviously. Can't be right all the time. But that's my guess. My guess is we go to all-time highs by the end of the year. I mean, we go over these charts all the time. Yields are peaking. Yields peak. Dollar peaks. The macro forces of the dollar looks kind of bullish, though. I'm not going to lie. Even though the RSI is bearish. Like, the RSI is pretty bearish. It is falling. If it comes back down, you get the dollar down because you get people buying equities. Why? Because earnings are better than expected, better than feared. And they were, they're going to have to capitulate. They're going to have to capitulate and start buying stocks. And they look pretty attractive when levels came all the way back down, at least for the Qs, all the way back. I mean, this is a 50% retracement, I believe. I think this is a 50% retracement from the break. Is it from the breakout? I can't remember. And we're still on the trend. We haven't even drawn the technicals, but look at this. We're still on trend. So let's do SPX technicals. Okay. There we go. Oh, that doesn't look good. It really doesn't. Unless you change it to a regular chart, it looks a little better. It improves a little bit. We are breaking the uptrend. The uptrend is starting to break down, and it's going to come down to earnings. It's really going to come down to earnings, and if yields have peaked. That's why we're tracking earnings at this time. Oh, thank you, Slime Z. I appreciate it, man. You don't need to show the charts, only if you want to. My old charts still stand for Mag 7. Microsoft looks to be breaking out. Google breaking down, 100%. And we'll see. Look, you could get Microsoft sell off and Google bid up. We'll see how it works out. I think the dips get bought in because, I mean, Mag 7 is just strong going into earnings. Very strong. A lot of people want to get back. Again, thank you, Slime Z. I appreciate you, man. Day oneer. I remember since the beginning of the year. Yeah. I mean, I don't want to brag. No, I'm just kidding. I do. No, I'm just kidding. I don't want to brag, but yeah, we've been long the whole time. And if you want to know who I follow for that, it's been Tom Lee and it's been Raoul Pal. Raoul Pal and Tom Lee. They've been right the entire time. And I don't think it changes. I think we go into a year-end rally. Now you're getting crypto starting to lift. Bitcoin is now, starting to break out ahead of schedule. The ETF could be passed this month, I believe. Ethereum starting to break out of this, falling channel. ETH dominance is down. Bitcoin dominance up. Chainlink, I mean, that made Chainlink led the rally. You guys know we've been talking about Chainlink the whole time. And we're, talking about it here at $6, $5. You remember when I came out and said, all right, I'm buying Chainlink at $5. Well, I mean, from the highs, that was up 100%. It's just getting started too. This is a 5 billion market cap. This is a small coin. What is Chainlink? It's just Chainlink is just an oracle. Nah, bro. I'll debate any of you crypto guys. Usually you don't know what you're talking about, but I'll have to bring my brother on because he's smarter than me. The dollar needs to decline for a sustained rally. I agree. It could move sideways though. If earnings are positive, the dollar could just move sideways and the market can still go higher with the sideways dollar. But if you want like a really strong, like if rates peak, dollar moves sideways, earnings are great, earnings are good, you're still getting fiscal liquidity, the inflation is coming down, you go up. The market's going higher. Why? Because inflation is making progress lower. And people just don't want to believe it, but I mean, and the Fed is done hiking. The Fed is pretty much done hiking. So the dollar, I think the dollar is going to make its move on November 1st. So I said, hey, the bull market starts last, that's a really good question, Bukowski. Always with the good questions. Now I forgot what I was saying. I don't remember what I was saying. Either way, so what was Mike Wilson's bear argument? That consumers, this was the bear argument, guys. They said the Fed is still selling bonds. Well, yeah, the Fed balance sheet's coming down, but Michael, who cares? Who cares if they're removing liquidity if when things break, they start buying back. So keep that in mind, bro. Keep in mind, right? Let's throw on the Fed's balance sheet. We didn't even go over liquidity yet. This is S&P versus liquidity. Keep in mind when the yes, the Fed is selling treasuries, but when something broke in the market, boom, $500 billion back into the market. So as long as they plug the holes, who cares? Who cares? As long as the Fed steps in and plugs the holes, who cares? The market is going higher because the Fed can do QE and then start tightening again. They can save and then come back, right? Now, if they let consumer deposits fail, yeah, heck, the market's going lower. There's going to be a market crash. All spending collapses. But to your question, Bukowski, his bear argument, and guess what? He's only he's at 95. He's 95%. Like Mike Wilson has shifted. He's 95% into the market. I think we talked about this. I showed a couple videos. Let me see if I still have that. Actually, let's see. I might have this on the video deck. When Mike Wilson said that he's basically, I don't know if I have it on here. But he basically said, hey, we're 95% invested. I'm like, bruh, you're bearish and you're 95% invested? Well, shit. I mean, the guy's 95% invested. And he's only weak on the non-premium stocks. He's bearish on cyclicals. He's bearish on cyclical stocks that have to do with consumers. Great, it's a strategy. Yeah, consumer spending slows down. But he said that consumer savings would run out. Disposable income would be down to nothing. That's not true. We're up a trillion. And so, consumers are still spending. They were just wrong about it so far. And also, he has earnings really missing here. But are earnings going to miss? We'll see. We're literally in earnings season. This is it. There were a lot of fake posts about BlackRock ETF. Have you seen it? Are they posting so much about it because of it? So much about it because it closed. Yassine. There were, yeah, but the thing is, they're amending. So they had to amend. Somebody said like last week, oh, BlackRock ETF is passed. It was false. They had to amend it and basically put Coinbase and somebody, I don't know, they had to do something. So once they redo that, it's going to get passed. Gary Gensler also is not challenging XRP. So there's all these signals that the ETF is going to get passed. JP Morgan also came out and said it's going to get passed. They could be fooling you, but it's going to get passed either way. JP Morgan said October. Morgan Stanley said, or they said October or January. Morgan Stanley said this year, by the end of this year. So people are front running the institutions, period. Is Mike Wilson really bearish when he's 95% invested? Nah. So he's kind of changing his tune a little bit. And that's fair enough. Smart. Hey, you got to change your tune when the data changes. I'm not hating on Mike Wilson. I'm not hating on anybody. I'm just calling out bullshit. Period. I mean, change your view, you already know my view. If the dollar spikes, if oil spikes, if yield spikes, which they have been spiking in the dollar, and the market actually has been pretty resilient in the face of this because earnings have been better, because AI came out. I never predicted AI, by the way, in October when we called the bottom. When I first started making videos, I didn't realize AI was going to come this quick. And so I'm like, damn, that's even more bullish because, well, for the Mag 7, but that's what brings most of the growth. Oh, well, it's not a real bull market because the Magnificent 7 are the only things learning. Who cares? Then buy one of the Mag 7s on a pullback. What's your point? You want to own S&P while the Fed balance sheet debases you? AI is the new .com. Troll. What up, Dima Yush? What up, man? I was banned for a while. Bear market, you mean the bull market bacon? Oh shoot, dollar needs to chill. The Fed is still selling bonds. Yeah, the Fed's still selling bonds, but I mean it's irrelevant. It's irrelevant. They can reverse at any point if something breaks, so it doesn't matter. What if all the institutions are front-running retailers with propaganda? You can't play the same game in a battlefield you don't own. What if all the institutions are front-running retailers with propaganda? I would say they are. I mean, Jamie Dimon back in the day said Bitcoin is trash, it's rat poison, when they were literally buying the most Bitcoin in Europe. So there's all kinds of evidence for them. When they talk negative, they're usually buying. And then whenever Bitcoin's at all-time highs and they're like, Bitcoin is the future, they're selling it. It's all about the cycles, right? At the end of the day, your best instrument is, can I read the technicals? What are the technicals telling me? Are fundamentals starting to crack? What is sentiment and positioning? What is the macro starting to say? And that's why we're building a course, so that you guys can at least learn from how I think about the market. Do I know everything? No. But if you want to be able to process all the information and make your own decision, I'm not going to tell you what to do. Then I'm going to, we're making that course for all you newbies and anybody else. What if all the institutions are front running the retailers? Oh, you said the second part. You can't play the same game in a battlefield you don't own. Maybe I'm just stupid, but I'm failing to process that last part, Carbides. I really think my only response is like crypto is the only asset class that you can front run the institutions. Maybe that's what you're saying, because you can own it before they get in, because they can't just buy a bunch of crypto, which is the Bitcoin ETF. You can literally front run the institutions, right? Not at all-time highs, but where we're at. So that's what's happening right now. There's too much excitement. The supply is falling. The dynamics are pretty bullish. Remember, the judge for the Grayscale case said, why is their futures product and not a spot product made second look stupid? Oh, SEC looks stupid. Yeah, exactly. Yeah, because they're trying to keep the price down. That's why they're over there saying, we're going to delay the ETF. We're going to delay the ETF. They're delaying the ETF so they can buy more, period. Whoever is in control, probably BlackRock, State Street, whoever, they want the SEC, they want the delay so they can keep buying lower. And when it gets past, they've already pumped their bags. They could delay it again. They're going to keep trying to buy as much as they can, as low as they possibly can. That's the name of the game. Dima Yush. Jeremy, what do you say if market sold off Microsoft and Google earnings tomorrow? Say if the market sold off tomorrow, I mean, you still have Apple earnings. Let's see, what is the if the market sells off tomorrow, I would say it's the market could be just selling into it might just try to digest all the data before moving higher. Microsoft and Google just beat expectations. The only thing that Google missed on was YouTube. So I think that portfolio managers are going to just reallocate, but they want to wait for earnings to totally finish, right? So where was that report, or not report? Where was let's see if I can find it. It was on my Twitter. I posted it, I think last week at the end of the week, and it was basically the calendar. Let's look at the calendar. What do we got going forward? Oh, also Japan, yield curve control. They're buying back bonds. So here comes more liquidity into the global market. Global liquidity should be picking up. Where is it? 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 Where did I post it? Dang, this was a while back. Here it is. All right. So Microsoft earnings here. I'll put this on the overhead. All right, so Microsoft earnings beat, Alphabet beat, Visa beat, Coke beat. Oh, Alphabet's going down. Well, I mean, it's the first day. Who knows? Forget the price action. The underlying truth is Alphabet beat in general, okay? We got Meta, but before that, we have GDP. We have, how did I miss the Fed speak? I missed that one. That's tomorrow. I think Powell speaks tomorrow, so I missed that. My bad. GDP growth rate, we'll see if GDP's at. It's expected to come in at 4.1%, bro. And that's the third quarter. The fourth quarter should be even stronger. It'll be Q1 that's probably weak. So I think we rally all the way through maybe February, March. I think that's my guesstimate. The rally might not start till October, November, end of November, beginning of November, because we have Meta, we have Amazon, we have MasterCard on the 26th, which is Thursday. We have Caterpillar, we have UPS. So those are all going to give us insights into the biggest companies and the consumer, how they're really doing going forward. Caterpillar, fiscal policy. which is basically all the infrastructure build, all the capital that goes into infrastructure. Caterpillars and industrials are going to win because, I mean, there's a labor shortage, and because you're still building infrastructure, and because the government's going to basically support that. UPS is really going to give you insight into the consumer, all the deliveries, XYZ. Friday, you get core PC, you get the Fed's preferred inflation gauge, you get the consumer, you get personal income, personal spending for the consumer, the personal savings rate. We'll see how that comes out. A lot of packed info. And then the Fed interest rate on November 1st, we could get a sell-off into that. And then you have Apple, you have Starbucks. Apple to finish off. I mean, you still have NVIDIA later down the road, but you have Apple, Starbucks. I don't think we really violate 420 or 418. I think that was a recent low. But either way, I think the setup is still bullish for the market unless we get some type of surprise, right? Which would be the war. So if I don't want to just say, oh, the war accelerates. It's going to have to be something significant. Like, I mean, Iran is I didn't realize how big Iran is. If Iran did some type of nuke or threatened nuclear war, or if Iran, if Hezbollah did something, like if something big happens, yes, but I don't know. We'll see. We'll see how that plays out. I'm not really too concerned about tomorrow. I'm looking much further ahead. You got to look 6 months ahead to guess the market, not tomorrow or next week. But as a day trader, yeah, I don't know. We'll see. We'll see how the market plays. I think it's oversold, so there should be a bounce. There's more pressure to the upside because there's so much pressure to the downside. It's gonna have to, it's like pushing a beach ball down into the ocean or into water. Eventually, just a little bit of, rates come down a little bit. The dollar eases. Earnings are a little better. The shorts cover their positions, and that beach ball starts to rise pretty quickly. In stocks, there's a lot of insider knowledge and methods of manipulation of data, liquidity, etc. But with coins, institutions are not as capable of doing it. They want to own the battlefield. Great. Hey, that is one of the best explanations I've ever seen. I've ever read. Trying to pump them up. See if I can do this. Damn it, I don't have it on here. That's 100% true. That's why crypto's king at the end of the day. Oh, well, crypto's a scam. Crypto's a scam. It's just a scam. 99%. Well, Bitcoin's a scam.
Stupid.
And then Bitcoin's up 100%. And I mean, that's basically what you're going to get. So 100%. I agree. Well said, Carbides. That's just a guess because that's what I would want before coins explode. Yeah, they're going to explode. You're building a course. Where is it coming, bro? I am really interested. It's going to come through the website. I'll let you guys know when it's done. It's just something else I'm adding to get out there. So you'll know, Yassine. I'll start marketing it pretty soon. How much would you pay for a course? For a whole macro course, right? Stocks, bonds, macro, basically reading the whole landscape. What would you pay for it? What's the most you'd pay for a course from me? Obviously, if you don't know me and you're new, you're probably like, what? I don't know you. Why would I pay? Fine. I'm cool. But just stay tuned with the content. Either way, what would you pay for a course so I can get some pricing? Don't say $2. I'm not going to sell a course for $2. Got to put my blood, sweat, and tears in it. But yeah, that course, I'll let you guys know when it's ready. The crypto market is tiny, of course. Crypto's manipulating. Yeah, everything's pretty much manipulated. It's easy to push crypto along, but when the secular, and secular as in the long-term adoption, like when JP Morgan has a private blockchain, when Swift Network is going to tokenize other assets, when BlackRock says they're going to buy Bitcoin ETF, it's pretty much crypto's going much higher from here. And a lot of coins won't get to all-time highs, which is why you have to know how to like know what coins to look at. And there's so many coins. It's just like, bro, I'm a riskier type of investor, growth. But when it comes to crypto, you want to be conservative. It's already high growth. It's already high beta. You want to be very conservative. And when I say conservative, they're going to move up a lot. So Make sure it has a solid fundamentals. You don't want to wake up. It moves 24/7. You're gonna wake up one night and it's down, 60%. We benefit from scamming to the upside. Sell before it all breaks, in 2022. Yeah, actually, crypto peaked, I would argue, in April. And look at, we're gonna also for the course explain what really peaks crypto. I'll stay up to date, but I think I know how crypto peaks, and it's going to be a combination of the macro, a combination of liquidity in the Fed, so policy, macro, and technicals. I've been looking at this for 2 years now. Like, where did I go wrong? I actually sold at the top, but if I would have known this, I would have not bought back so soon. So there's a lot to be learned. I just find coins that outperform BTC at year to date, such as Pendle and INJ. All right, Doifer. Well, good luck, bro. I don't have no clue what that is. Actually, I know what Engine Coin is. I actually was in that for a while. I haven't looked at that actually for a long time. How's it doing? Engine Coin? I think that's what it's called, Engine Coin. Oh, dang. Nice cup and handle. This thing is up a lot. Whoa, I didn't realize Engine Coin was up that much. This thing is breaking out. This is like the NFT marketplace coin too, I believe. Wow. I think this is the one, Engine Coin, if I got it right. Nice. Oh, this is Injective Protocol. Okay, then I don't know what this is. It looks similar. Maybe ENJ. I don't know what Injective. I wonder what the market cap is. I don't know what it is. And that's why I say conservative. I wouldn't get into something I don't understand. I think I learned a lot from you. Most of the things I learned are from you, the articles on websites like Leading, Coincident, and Lagging Indicators, and some others. And it's going to be more organized. The course will organize all the information and how I process it. So yeah, I have already free articles. I have a lot of free stuff out there, but organizing it in a way where you can, where it's just more organized, it's put together. It's something you can look back on, market terminology, all that stuff, and some extra stuff on there too. And I'm thinking if I do a trading technical course, I might do it different, because that's a whole nother monster right there, trading. There'll be technicals in this course though. There will be fundamental technicals, or actual technical indicators, or not technical indicators, but charting and technicals will be in this course. But it won't be a professional. It won't be like a professional trading course, because that is a whole nother monster. I don't think most people are going to succeed even if they do a course on trading, to be honest. What up, Asan? E and J. Oh, it's E and J. Okay. E and J USD. Yeah, I was off on that. Dang, that thing is down. Oh my gosh. Thank goodness I sold it. 20 cents. Wow. So if it's kind of like, but I wouldn't pay 100. All right, that's good to know. You wouldn't pay 100. I'm gonna make it 101. No, I'm just playing. All right, cool. Utility tokenomics. Oh, yep, utility tokenomics. That soundboard. Oh, the soundboard. Yeah, I got to get it better. I mean, what if good earnings is not good enough? Oh, Dimayush, what if good earnings are not good enough? Well, think of it this way. If the market, last time we had the market bid up into really, really good earnings, better than expected earnings, and then sold off because the market is, the market is very forward looking. So what we could get if it sells off is basically, well, we're going to anticipate something bad happens. If it doesn't happen, then we actually start to bid up into earnings. Preface that with, and you're adding into that the Fed pausing, you're adding into that inflation coming down, you're adding into that the top in yields, which is a big recipe for confusion. So I would say alone, nothing, it's not really that serious. Because really it's all about, future expectations of growth, earnings growth. Is it rising? Is it, we're coming out of earnings recession. Just put it this way, a lot of fund managers, Dimayush, are in cash. We see cash levels Average cash levels are 13%. They're at like 15, 17. They're as high as they were back in 2020. So that cash will find its way back into the S&P, probably into the Mag 7 for the most part. Nvidia probably rips higher again. AMD still looks like AMD is real. I always say AMD is tricky. It looks like it's going to break out and then it comes right back down. AMD is tough, which is why I just stick with Tesla. Man, AMD is a tricky one. But you got to have your stops if you're trading. If you're investing, you should be straight. Either way, yeah, I would say, hey, you could be selling off into a buy. So there's just too much data to think it's just about earnings. I think earnings are better because look, we've sold off. We're down. The S&P is down 9-10% into a better earnings season, into earnings that are actually growing. Well, that's a good setup for, buy. I think there's going to be some buys here. Now, obviously, some companies are not going to get bought, so they're going to get less left in the dust. That's my view. My 401k in cash 100%, money markets. I mean, cool. Your 401ks and money markets, while the market is up. Let's see, what is S&P up? This is the whole thing about the money markets. There's a place, if you're looking to buy something in cash, great, put it in money markets. But if you're looking to invest, if you're trying to invest the money, it's really not that smart. S&P is up 31% from the lows. I mean, if you want to just look at January, right, for the year, S&P is up. Let's go January. S&P from January 1st was right here. S&P was up 21% from the highs. It's up 10%. So it's outperforming, money markets. Nasdaq's even crazier, Demiush. I am looking forward. Yeah, if you're looking to buy something, it makes sense to stay in the money markets. But if you're looking to invest, I mean, why would you be in money markets? That literally doesn't make any sense. Unless you think, unless you believe that there's a financial crisis looming, which a lot of people believe that. So Qs from January, this is insane. From January, 48%. I mean, golly, 5% money market funds in the Nasdaq's up 40%. And today it's up 35%. Why would you be in money market funds? It makes no sense if you're trying to earn something on that. Okay, let's go to Bitcoin. How much is Bitcoin up from January? 114% as of today. So money market funds, if it has to make sense. But if you're looking to invest, you don't want to be in money market funds. What are money markets? Yes, hopefully shallow recession and buy opportunity. That's what everybody believes, though, Demiush. Everybody believes shallow recession, buy the dip, but the market is forward looking. The market bottoms 9 to 12 months before earnings actually bottom. So maybe you're looking for a pullback, but this is the pullback. We're pulling into the trend. I mean, to me, this is the pullback. You're pulling into the trend. You're basically up against the 200 moving average. Earnings are set to go higher. The consumer is still spending. Oh, but rates may have just peaked off of Bill Ackman. Even if they haven't, the market historically can still move higher as long as the ISM is moving above 50, and it is starting to move above 50. We just got the global S&P PMIs, and they're starting to get above 50, which means forward-looking growth in GDP is going to be moving higher. And fiscal policy is you're getting fiscal policy. You still have, I mean, if you're invested, you're great. Just comes down to when the Fed starts to shift, the market's already way higher. It's going to leave you in the dust. You buy the weakness. The people online saying, oh, there's a big crash coming. Bro, we went through I would debate anybody. Throw anybody on here, I'll debate them. They just don't. It's a lot of stuff. It's a lot of the market is very forward looking. That if everybody could guess it that easily, most people would have made money already. There's people still waiting from 2008 to put cash in for the bigger crisis. And they're, I think they're basically brainwashed. They're buying gold, which has gone nowhere. So if you could explain more about the numbers, about the news, I would have no problem with paying for it. I'd say it depends on how much it is. So it's saying what it is of the course. Okay. We'll see when it comes out. I mean, we'll What do you want to see in the course, Yassine? Tell me what you want to see so I can add some stuff in there. Some Forex. I don't trade Forex, but I do dollar analysis, you know, when it comes to how the macro impacts the dollar, other central banks versus the US. Yeah, we'll see how that plays out. So, also, let's see where we at. And then let me hit those main points again if you're just walking in here. Forward-looking earnings are just up. U-shaped recovery for earnings per share. So the market, you think the market's going to sell off because earnings are better? It's going to sell off because earnings guidance is lower. And that just, I mean, where's that going to come from? The consumer? Well, the consumer is set to keep spending. So where's that going to come from? Where's that chart at? And there's a lot of people in cash. The LEIs are separating from, like, everything sets up for a bull market rally. It's just that typically it's your money, so you're scared, you're fearful, which is fair enough. It's fair enough. Take a step back, but if you have a long view, then you know you're looking at pretty good. Here's this chart. This is the chart I was trying to show. If you guys remember this, if you follow the newsletter, this has been in the newsletter every time for a while. This was way back. Basically, equities typically bottom, trough, same thing. And that's part of the market terminology. When you hear trough, it means bottom. 6 to 9 months before earnings reach their low in past bear markets. So back in October of 2022, I kept telling people, bro, the market low is in. We're not hitting new lows. You guys remember me on TikTok. I don't know about YouTube, but I said the lows are in. The lows are in. We're not going to hit another low. And it's not that I know, but I'm saying basically when I look at all the data and look at all the history and look at all the correlations and look at what we're, you know, everything, the technicals, the lows are in for the market. You got CPI really surprised to the downside, which helped investors get more reluctant. And when CPI, really, this is all about inflation fight. As long as inflation continues to make progress, this bull market is not going to roll over. 10 years peaked. The 10-year peaked. Guess what? If we just got the 10-year peak from Bill Ackman yesterday, markets are going higher because that means the dollar is going to peak also. So this is basically zero, which was October. 6 months later, April, I said, look, it wouldn't be out of the ordinary for EPS to continue declining, which was, you know, January, February, March, April, for earnings per share to be declining and the market still move higher because the market typically prices in or bottoms 6 to 9 months before earnings bottom. So basically you have April through July for the bottoming, for the market to still move higher. You're waiting April to July for earnings to bottom. Guess what? They bottomed. Earnings bottomed, literally forward-looking estimates bottomed somewhere in April, May, June, somewhere in April, May, June. The market does it all the time. It bottoms before the earnings bottom. Earnings are now this month that we're looking at, earnings are due to leave the earnings recession. They're moving positive now. What's leading that? Technology, communications, consumer discretionary. So it's like earnings are picking up, estimates are forward, everybody's betting on a black swan for that to end. So you need earnings to collapse. What the hell is going to collapse earnings? And then that brings us back to the other segment. What's gonna get us to collapse earnings? It's gonna be, you know, it's probably gonna be broken supply chains. No, I'm just kidding. It's probably gonna be the consumer falling off a cliff. But what did we just see? That consumer savings, they still have income. They're still gonna keep spending. They still have jobs. I think it does come down to the employment report, right? At the end of the day, when it comes to recession, and people still have jobs. And guess what? Immigration. We didn't even talk about immigration. But as long as there's more immigration, legal or illegal, we're not talking politics here, then the labor force gets filled and you don't get wage growth because the hospitality industry is going to benefit from that. And they have money now. They spend the money. Spending doesn't slow. Blah, blah, on and on and on. On and on and on. So I think we're headed. The leading indicator article, I would like to see something like that, but expand because not everything is in it. Also, things like if GDP goes up, inflation goes up, interest rates goes up, currency up. Yeah, I'm going to break down the details in that stuff. Those are just posts. This is going to be the master course. This is going to be everything I know. Everything that I understand is, you know, that I understand because the market is always changing. So, and I'll also add to that course. So it's going to be a course where you can, you know, look back, or you'll get a signal that you'll get an alert that the course is updated. So it'll be an updated course too. Shout out to Isaiah Fielder. That's my brother. He's the one who built the course from scratch, by the way, and is building the course. And if you feel like you want to build a course, you can actually build a course on our website when it's ready. So what else do we got here? I think we've went through everything. Google analysis. I don't really have analysis on Google. I'm sorry. Google's, let's see, Google analysis. I mean, it's down right now. You mean on a technical or fundamental basis? Fundamentally, we'll look at the earnings. Google beat bottom line revenue. They're doing great, but the cloud business slowed. So investors are selling off because that wasn't expected. It probably gets bought up anyways because it's still beating. The forward-looking earnings are still positive for Google. YouTube, the YouTube segment is pretty strong. I'd have to go through. Actually, let's see what they say right here. Ad growth. So ad growth accelerates as the economic outlook improves. So the ad business is growing. That's YouTube. They expect fourth quarter headwinds in hardware segment. So hardware segments, data centers, Google ad growth accelerates. Oh, Waymo. They're still invested in Waymo. They're going to get crushed by Tesla. Alphabet says Waymo gradually adding users from 100,000 wait list in San Francisco. So Waymo's developing. Taking actions to, office space. So that's the other thing. Their commercial real estate is probably underwater. Their commercial real estate, maybe rates are high for that because they have to refi. That doesn't mean Google's going to collapse. They have tens and tens, probably $100 billion on their balance sheet. I'm not even sure. But Google has a lot of cash. They can buy back shares and literally make their EPS go higher if they wanted to. So hardware is slowing, cloud is slowing, data center slowing, everything else is up. Announced reduction of workforce, that's big. Recorded employees severance and related charges, 86 million. So if they reduce their workforce, they're adding AI. AI is gonna increase the productivity of all these companies. That's why I still think the Magnificent Seven are gonna be magnificent. Would you say, Yassine, you find it hard to put everything together? Yeah, it's tough. It is hard. It is hard to put everything together. That's why I spend most of my time trying to put this stuff together every single day and now put it in a course. Have you already been through trading economics news and how that could impact the dollar? Tomorrow, no, not yet. Tomorrow's data is, let's see, tomorrow we have, let me put that up there. We'll end with this because I got to get going. I got to get to work and build that course. Okay, so we have, what is tomorrow? Tuesday? What is today? Tuesday? No, today's Tuesday. All right, so tomorrow we have new home sales. I don't think this is the housing market is frozen. This probably doesn't do anything to the market, honestly. The market knows the housing market is going to be frozen until rates get cut. The big thing for the dollar tomorrow is going to be Fed Chair Powell's speech. I don't even know where he's speaking at. Somebody let me know on Twitter if you know where he's speaking. I was trying to look it up. I'll probably look it up after this. I couldn't find it. But if he is speaking somewhere, if he's going to speak somewhere significant, then I will be streaming it. Last time he was speaking at some school and it was insignificant. So we'll see. But there's not much data tomorrow. It's mostly earnings. Earnings are going to be it's going to be Meta earnings. All right. Anyways, before I pee my pants, I got to get going here. So I appreciate you guys jumping on. As always, stay blessed. Get your workout on. Get your health up. Keep positive. We'll catch you guys later. Tom Lee said, if unemployment stays low and labor has a continued shortage, that Mag 7 will slowly become 50% of the S&P 500. Well, not the Mag 7. But NASDAQ in general, technology in general, but the Mag 7 will benefit the most, yeah. Especially with Doifer, especially with the Tesla bought, right? So Tesla has a lot into it. Anyways, I got to go. Catch you guys later. Stay blessed. I appreciate you guys as always. Take